Good afternoon, everyone. You're very welcome to the first public sector session here in 2025. I hope you all had a really restful Christmas and are back reinvigorated for the new year. For those of you who don't know me, my name is Graham Wilkinson. I am the chair of the Public Sector Committee in the Ulster Society. We've had a lot of positive feedback about our series of events that we held in 2024 from you all. We've also had a lot of good suggestions and a lot of good ideas as to what we might embark on in 2025. So that's something as a committee that we're currently looking at. But today, we're really excited to have Robert Kirk along with us today to give us a bit of an insight into accounting for leases. Robert will be no stranger to many of you, having grown up listening to Robert giving various presentations, teaching many of us at university. I've always found his lectures and his talks very entertaining. I'm bringing some of this subject matter to life and giving real life examples. And I hope today's session you'll all get something out of it. I think, Robert, we've given you an enviable task of bringing leases, accounting for leases to life, but I'm sure you will do an absolutely fantastic job. There is a bit of a chat function on the Zoom call. If you do have any questions, please do pop them into the chat. We will leave a bit of time at the end of the session just for some Q&A, because I know this is a very complex and complicated area, and it's great having Robert along with us here today to answer any questions that you may have. So we're very keen to use the time that we have to get into this important area. I know Robert's going to give a little bit of a summary as well, just of sort of key issues that are also coming out of the accounting world. So, Robert, I'm going to pass over to you. And again, any questions that you guys have, just pop them into the chat. Thanks, Robert.
Thanks, Graham. Good afternoon, everybody. I'm delighted to be asked to talk about this particular topic, which I know is raising some hairs within the public sector, and not only that, in the private sector as well. I was giving a talk to some accountants in Essex there recently, and the words I got by were bullshit and all this dreadful words coming out. What on earth have they brought onto us again through these new standards that they brought in? But I personally am in favour of it, because I do believe it does show the true and fair view of the various assets that we get under our lease agreements. Anyway, I'm assuming that a number of you are involved specifically in financial reporting, but a lot of you are not. And so therefore, I'm going to kind of basics and then take you through the various differences that exist between the public sector and the private sector, particularly in the adaptations and interpretations in the government manual. So without any more ado, let's go ahead and talk about the reasons. Why has this standard come in? What's the reason for it? Well, there's no doubt about it. Leasing has become a major source of funding. In fact, in many cases, has replaced buying it outright. You might argue it's cheaper. It may not be cheaper, but certainly a lot of people feel that it was a better way of funding their fixed assets expenditure. And because of that, we no longer have a complete picture of the lease activities of an organization up until now. In fact, until this new standard came in. Yeah, the old standard was called IS 17, and that tried to solve the problem. It tried to split leases between finance leases and operating leases, but it didn't work, because majority of people, when they were playing with leases, deliberately, in my view, tried to keep their leases off balance sheet. So they didn't show assets, they didn't show liabilities relating to lease agreements on the balance sheet. They classified them as operating leases rather than finance leases. So the two major standard setters in the world, that's the Americans, the FASB, and the International Standards Board, got together actually and tried to bring out a joint project on the topic. Unfortunately, they didn't come up with the same conclusion. We've come up in international accounting with a single conclusion. The Americans have come up with what's called a dual conclusion. But I'm not going to go into the American way of doing things. I'm just going to cover, obviously, the international one. The principles basically, as for all standards really, is to set out what you need to recognize, how do you measure things, how do you present them, particularly in the profit loss and balance sheet, and what you need to disclose in the notes. All the standards do that. Its objective is simply to provide relevant information to ensure that both parties, lessors and lessees, do fairly represent their lease transactions on the balance sheet. Now, you will find that I don't necessarily agree that they've achieved that in terms of lessor accounting, because they haven't really changed lessor accounting, which is rather strange, because it does mean that in many cases, the asset that's being leased will be on both sets of books. It'll be recorded as a kind of physical asset in the books of the lessor, and a right to use asset in the books of the lessee. And that does cause problems when you're dealing with consolidation, because then you have double counting. Now, that's probably less of a problem in the public sector and the private sector, but has caused a real difficulty, because there's no let out, there's no exemption, if you like, for group entities in that situation. Now, the main features are, as I've said, unlike the Americans, we're introducing what's called a single lessee accounting model. In other words, you either have leases or you don't have leases. You have service contracts, if you like, but certainly not two different ways of dealing with it. It requires lessees to recognize assets and liabilities for all leases, with one or two exceptions, as we'll see shortly, on the balance sheet, or, if you like, the statement of financial position. As I said, lessor accounting is substantially unchanged, so they will continue to classify leases as either finance leases or operating leases, and that's where you get the double counting from. But both parties, both the lessor and the lessee, will have quite a substantial increase, to be honest, in the amount of disclosure that's now required. The little cartoon, which I've shown for quite a number of years now, shows the former head of the International Standards Board, Sir David Tweedy, who every time he got up to speak, and probably many of you have heard him speak here in Belfast, basically said he would love to fly on an airplane that was actually on the balance sheet of the airline that was flying with, because all of the aircraft seemed to be leased and none of them seemed to be on the balance sheet, which didn't reflect the reality that they were able to control these assets and really should be putting them on the balance sheet. So David's retired many years now, but he would be delighted to see that the plane has finally landed on the balance sheet there at the bottom of the wheel. Now, there are two exemptions. In the private sector, they are optional, but not in the public sector. In the public sector, in the government FReM, it's compulsory that you must not capitalize any short-term leases, and they're defined as leases which are genuinely less than 12 months. Now, if there's any form of option, particularly a purchase option or a renewal option, that's not less than 12 months. That would be the case where, in the case of an extension of a lease, it's almost certain you're going to exercise that extension. Then that's definitely not less than 12 months. As regards low value items, this is optional for both private and public sector, but is mandatory on transition. So on transition, you must not capitalize any low value items. But it leaves it very much up to individual departments to decide whether they want to capitalize them or not. Now, the standard itself does have a guideline. It's $5,000 basically, as a rough guideline for what they would regard as low value or high value. In fact, in the local standard here that we have in Ireland and Britain, we've got FRS 102, and they've actually not tried to put a figure on it. They've actually more or less said it's very much up to you in your own personal circumstances to decide what you think is low value and what is high value. What they've actually done in FRS 102, they listed a whole series of things which they believe are high value, but they're fairly obvious things like motor cars and tractors and ships and buildings and things like that. So it's very much on a lease by lease basis. You've got to decide whether you want to capitalize them or not. Now, what is crucial, in my opinion, in this standard is defining what an actual lease is. Now, clearly it's a contract that's drawn up between the two parties that conveys to the customer the right to use the asset for a period of time in exchange for consideration. Now, that's fairly obvious. But then the second sentence is the one that causes the problems, because it says a lease exists when the customer is able to control the right to use an identified item. And that is when the customer has exclusive use of the item for a period of time and can decide how to use it. Now, that second sentence is crucial because that is where you have to distinguish between a lease agreement and a mere service contract, because service contracts are never capitalized. Now, what do we mean by identified asset? Well, it could be a building which is actually in the contract that you've signed, but it doesn't have to be explicitly specified. It could be implicitly specified. And even if it's explicitly specified, a customer would not, and I repeat, would not have the right to use an identified asset if the supplier has a substantive right to substitute the asset throughout the period of use. Now, classic example of that, and it's maybe not particularly important, but let's say you had a supplier of machines for chocolate or something like that in your premises. Normally, they would have the right to pull that out and put in a new machine. And possibly also the majority of the income would be going to the supplier, and only a small amount would be going to the user, if you like, or the customer. So it's that kind of situation where you have to decide, does the customer have the right to substantially substitute the asset throughout the period of use? And that's explained in that third paragraph there, where it says a right to substitute is substantive if the supplier has the ability to substitute alternative assets throughout the period of use, and they would benefit economically from the exercise of that substitution right. So it would be in their interest to put a new machine in place of the existing one. Now, control is also a very, very important feature. The contract must also provide the customer with the right to control the use of the identified asset. Not only do they have the right to obtain substantially all the benefits, but they have to be able to direct how that particular asset is being used. Now, there's a lot of guidance within the standard helping you to decide whether you have a right to direct the use of an asset or not. But at a very high level, I think one would argue you have the right to direct the use of it if you have the right to direct it and for the purpose the asset is used, or the relevant decisions and for what purpose the asset is used is predetermined. Then in that situation, I think you could argue that you have control. There is a public adaptation to this, and that's simply that in determining what is a lease agreement, they're also including intra-UK government agreements, so interdepartmental agreements. That are not necessarily legally enforceable. And we have a couple of examples just to illustrate that, which are taken from the guidance which is published by Treasury to help you apply the standard. This particular example has a Department A that enters into a lease with B, so two departments involved, and that allows Department B to use part of the building that Department A actually uses for the next 2 years. Now, the agreement gives Department B the right to use space equivalent to 1,000 square meters, and that's going to be used for office space for their own civil servants. But that's only 1,000 out of 30,000 square meters, of which 60% is currently occupied. Now, when you look at the agreement, you find that the Department B, yes, they have the right to use 1,000 square meters, but it doesn't say what specifically are the actual square meters that B can use. And if there's spare capacity there's no doubt that A could move B from one part of the building to another part of the building, and they have that right according to the agreement following a 1-week notice. So they can change the space that Department B can actually use. And they will do that probably in their own interest. They will do that if they could benefit economically from switching B to a different part of the building. Now, when you look at all of that, it is clear that the A has a substantial right of substitution. That is not a lease agreement. That is definitely not a lease agreement because of this substantive right to substitute the 1,000 square feet. Now, as opposed to that, we have a slight amendment to this one. Here, B has exclusive use for 2 floors in the building for the next 5 years. And B have the right to use those. They can direct and control the right to use those floors over the period of the 5 years. A cannot move them out during those 5 years. They can't evict them, except in exceptional circumstances. And A does provide cleaning and security services. Now, in that situation, that's a lease, because B now has the right to control the use of those 2 floors. So they've got an identified asset because they've got 2 floors of the building. They have substantially all the benefits flowing in, and they have the right to control those 2 floors. So those are the 3 yeses that you have to say. You must have an identified asset, that you must not have the other party having substantive right to substitute, and you must be able to direct the use of the asset. So in that situation, that is definitely a lease agreement. But there's no doubt about it, the key judgment area, or I use the word the battle lines that now arise in leasing, is no longer distinguishing between an operating lease and a finance lease. That was the old standard. The new standard, because there's no distinction anymore for lessees between finance and operating leases, they're just leases. So the new problem is deciding whether you have a lease agreement or merely a service contract. That is at the heart of the standard. Leases on balance sheet and service contracts off balance sheet. And in essence, a lease is where the customer controls the use of the asset. Generally, the service contract is where the supplier controls the use of the asset. But I picked this up from PwC. There's the 3 questions that I was talking about. You must have an identified asset. You must have the right to obtain substantially all of the economic benefits from using the asset, and you must be able to direct how and for what purpose the asset is used. In those, if you say yes those 3 times, basically, I notice there isn't a yes in the 3rd one, but you really need to say yes to the 3rd one, then the customer has control over the asset. That is a lease agreement. If there's no at any stage, then generally it becomes a service contract. Now, as I said, service contracts are written off as expenses. There's no doubt about that. But the problem is many contracts that you sign, unfortunately, include both elements. You've got a service element included within the lease contract. Typical example of that is where you lease a car with attached maintenance services, or you lease a building with attached security and cleaning services. Now, the standard says, and there's no adaptation or interpretation here for the public sector. So what you're supposed to do is to separate out the lease element from the service element and write off the service element as an expense, and then only capitalize the net figure, the amount exclusive of the service element on the balance sheet. The standard, however, realizes that there will be circumstances where it's probably not cost effective to carry that out. And particularly when the service element is not a very large figure, it's a minor figure, then it's just as easy just to capitalize the whole lot and not worry too much about the service element. But I think that the expectation is that should only happen when the service element is relatively small. Okay, we move on then to the actual double entry bookkeeping. Now, you always start in leasing with the liability, always with the liability side. And you work out all your future payments and you discount those back to present value. Now, there are 3 different discount rates that the public sector allows you. There is the actual implicit rate of interest in the agreement, which you might be able to get from the lessor, but you may not. There is what's called an incremental borrowing rate, which is really more of a private sector one. And then there's the government rate, which is published every December in the PES papers, the PES papers. Remember, they give you the discount rates every December for provisions and pensions. And here's now, you've also got uh, the leasing one as well. Now, so I would think most of you will be using the government rate. You then capitalize that. So in other words, you really fix it that the right of use asset is equal to the lease liability, initially anyway. Now you'll see dotted lines there. And the reason why they're dotted lines is that they may not happen. But where they do happen, you will have to capitalize them as part of the asset. First one is you pay your very first installment in advance. Now that wouldn't be discounted back to present value. So effectively that's credit bank, debit, right of use asset. Then in many agreements, you'll find that you have to hand back the asset in a fit state. You have to restore the asset in such a state that it's reasonable and fits the needs of the lessor. That's governed by separate rules. It's governed by the rules in the standard known as IS 37, which currently is actually under scrutiny. It may well be revised in the next 12 months. But at the moment, anyway, you have to have a probability of having to pay this restoration cost at the end of the life of the agreement. You have to have a reliable measure, and you be able to, if you pass those two tests, then you bring a provision on. That's a separate liability on your balance sheet. It's not part of the lease liability. It's separate. But it is argued to be part of the cost of the asset. You wouldn't be able to get your hands on the asset unless you agree to restore it at the end. So it's both a liability and an asset. And then if you believe the legal costs and any other direct costs are substantial, then those should be capitalized as well, rather than writing them off. So essentially, that is what goes in basically into the asset and the liability on day one. Now, the lease term. The lease term, you've got to be careful with because it can change on an annual basis. Initially, it's probably going to be the non-cancel period of the lease, let's say 10 years or 20 years. But many of the agreements that you sign, you will have an option to extend the lease for a further period of time, or you may well have an option to terminate the lease. That might be the situation at the moment, with people not requiring as much square footage in their buildings because of people working at home nowadays much more, and therefore not needing the office space that they used to have. So if those options exist, you have to look at those every single year to decide whether it's in your interest to exercise those options. Now, only if it's in your interest and you're reasonably certain to exercise the options do you bring the calculations into play. And I think that's unlikely in the first year. I think in day one, it's probably going to be the non-cancel period. But at the end of every subsequent year, you got to look at this and you will have to change the asset and change the liability every time. So it does mean you have to keep a running record for all your lease agreements. They're not fixed in stone. Now, in deciding whether it's reasonably certain that you will exercise them, you've got to look at all the facts and circumstances that might create an economic incentive for you to exercise that option. And you do that, yes, you do that on day one, on the commencement date, but you do it throughout the life of the agreement as well. Now, excuse me, what goes into the lease liability? Well, the obvious one is your monthly payment or your quarterly payment, whatever it happens to be, which is usually a fixed payment. But there are other payments. I think it's unlikely, perhaps in the public sector. I think it's more likely to be in the private sector, in the retail business, where the lessor may say to the lessee, excuse me, I want to charge you a rental based on your turnover. So that's a variable contract because it depends on how good the turnover happens to be. It may not be very big, it may be substantial. But often, even in those agreements, there would be a guaranteed minimum sum that the lessor would be entitled to. Now, that guaranteed minimum sum is argued to be in substance a fixed payment. And that guaranteed sum would be capitalized, brought in as a liability and capitalized as an asset. Also, variable lease payments, which are based on an index or rate. Many of your agreements will be subject to RPI or CPI indices. They will change every couple of years. As soon as the index changes and the payments go up, you've got to change your asset, you've got to change your liability. Immediately that happens. Same applies for expected residual guarantee payments. You do your best to work out what they will be at the outset, but that will change over time as well. Again, an exercise price of a purchase option, or should have put in there a renewal option. If they're reasonably certain to be exercised, they've got to be brought into your calculations. And any penalties for terminating a lease, if it's reasonably certain you're going to terminate the lease, then they are also brought in. So as you can see, it's not a fixed sum. The liability will change over the life of the agreement. And as a result of that, you also have to change the asset value as well. Dilapidation provisions, well, that's restoration. It's the same thing. I just want to emphasize that a separate liability based on the principles and rules in IS 37. So there has to be a legal or constructive obligation, which there probably is a legal obligation in the agreement that you've signed. There has to be a probability of outflow, and there has to be a reliable measure. But they are basically brought in as a separate liability, but they are capitalized as part of the right of the use of the asset. And the rationale, as I've already said to you, is that you wouldn't be able to obtain the right to use that asset without agreeing to pay for those future restoration and dilapidation costs. Now, I've already talked about this, but this is the discount rate. This is where the public sector have introduced a third rate. It would be very difficult, I think, in many cases, to determine the interest rate which is implicit in the lease agreement. So as a result of that, you are supposed to use the Treasury discount rate as your incremental borrowing rate, because you don't generally have an incremental borrowing rate unless you're using external funding from external sources other than Treasury, other than departmental funds. So it does, in the interpretation, it does say if you can demonstrate that another discount rate would accurately represent their incremental borrowing rate. For example, if you're able to undertake external borrowing independent of the exchequer, then you're able to use that as your incremental borrowing rate. But I would say 99% of departments will be using the rate which is published every December in the PES papers. Now, we've talked about the initial calculation of the asset and liability, and I've talked about the fact that the figures do or could change because of changes, particularly in the lease term. But then what do you normally do from year 2 onwards? Well, in the private sector, nearly everybody has opted for what's called the right of use cost model. But that's not allowed in the public sector, because the public sector has always had a greater commitment towards valuing their assets, keeping the assets up to date. So therefore, the right of use fair value model must be used. You either use fair value or current value in existing use, as per the IS 16 adaptations. Now, you might say, oh my goodness, we have to go and value these things as well. But it's not as bad as you might think, because if you think of particularly the current value in existing use, the real value to you of having this asset is being able to use it over the remaining useful life of the agreement. And that's the value of that is reflected in the future payments that you have to make, discounted back to present value. So therefore, the cost model really is a pretty good proxy to the fair value model. So even though they're saying you're using the fair value model, in effect, you can get away with using the cost measurement model. I personally think the fair value model shouldn't be used, because you don't own the asset. The asset is owned by somebody else. So any capital gain or loss will result in the books of the lessor never in the books of the lessee. So I always felt it should never be fair valued. It should really be the cost model. But anyway, that's the way it's been done within the public sector. Now, the lease liability, what happens at the end of every year? Well, you have your opening balance, then you add on the interest for the period, which is really the unwinding of the discount. Then you take away all your payments, your monthly payments. And then you have this thing at the end, which we're going to come to in a sec or two, and that is plus or minus reassessments and modifications. That's when you reassess your lease terms, or when you renegotiate the contract. That's called a modification, a renegotiation. Now, you charge your statement of comprehensive expenditure and comprehensive net expenditure, should I say, with the lease interest and any variable payments which are not linked to an index. Those which are linked to an index should already be recorded as part of your asset and liability. Now, what about these reassessments? Now, reassessments are going to occur when you change the lease term. Now, that change of the lease term will happen when you decide there's an economic incentive for you to renew the lease for a secondary period, or to purchase the asset. Now, it's probably unlikely you're going to purchase it, but you certainly would possibly extend it. But there's also reassessment if you decide that you want to terminate the lease early. Now, in those situations, if there's a reasonable expectation that you're going to do this, then you have to reflect the revised payments using a revised discount rate. So you're going to have to use the government discount rate at that time, not the original discount rate you used in setting up the liability in the first place. Now, exactly the same thing happens when you're talking about a purchase option. Exactly the same thing. When you feel it's reasonably certain that you're going to exercise the option to purchase, then you must reflect the revised payments using the revised discount rate, which would normally be, as I say, in your case, the government rate. So that's the reassessment. Now, here's an example where you've taken out a lease of a floor for 10 years, but you have an option to extend it for a further 5 years. In the primary period, you're paying 50,000. But if you want to extend it for a further 5 years, that goes up to 55,000. And the payments are paid in advance of the period. We'll assume that you've got 20,000 of direct costs. You're going to pay your former tenant 15,000 to replace them. Again, that's not going to happen very often. And you've got 5,000 commission. Now, as an incentive, the lessor has agreed to pay the 5,000 commission. Now, at the outset, it would be highly unlikely that you'd be in a position to say to yourself, oh, I'm definitely going to extend this lease in 10 years' time. You never know what's going to happen over the next 10 years. It could be that you get a better deal somewhere else, or maybe you don't even need the square footage in 10 years' time. So my view would be, it would be highly unlikely that you would be in a position to say you're definitely going to exercise the option. Therefore, in your opinion, the lease term at this stage anyway is 10 years. Now, don't worry about the bottom line, which says incremental rate is no implicit rate. But the incremental rate really in the case of the government is again, the Treasury rate, the PES rate from each December. We'll assume it's 5% just to make life easy. Now, the first thing is you notice that the first installment was paid in advance. So that's credit bank 50,000, debit right of use asset 50,000. Then you have 9 further payments, and using annuity tables, using the 5% discount rate, that works out to be 355,391. And that must go in first of all as a liability, and then automatically it's added on to the right of use asset. The second double entry is the fact that we're capitalizing the 20,000 direct costs, as we're required to do under the standard. But where the lessor has paid part of that as an incentive, any incentives, and I haven't really touched this, but any incentives which the lessor gives to you to encourage you to come to use that property, they are deducted from the right of use asset. So they are debit bank, credit, right of use asset. So in effect, we're only capitalizing 15,000 of the direct costs. But it does mean that the asset now is 420,391, which is way ahead of the liability standing at 355,391. Now let's assume that everything is honky-dory for the next 6 years. What do we do over the next 6 years? Well, we depreciate the asset, and we would normally tend to use a straight line approach. It's very unusual to have anything other than straight line, although that doesn't prevent you from using sum of the digits or reducing balance or some other method, whatever you want. But I would imagine nearly everybody will use right of use. Use the straight line method. Now the figure there over a 10-year period is 42,000 would be the annual depreciation charge. And by the end of year 6, the asset now has fallen to 168,157. Now let's have a look at the liability. We've already paid the very first installment in advance, so there's no payment there. The next payment's the first day of the second year. Now the interest is 5% of 355,391, which is 17,770. That would be added on to the liability, and then at the beginning of year 2, 50,000 is taken off, and then you would then charge the 5% on 323,161, and so on. So as you'd expect, the interest charge is high in the early years and then drops away gradually there. Now, as a result of the higher interest rate in the earlier years, what generally happens in these agreements is that the lease liability will very quickly exceed the asset value. Even if there are prepayments and even if there are restoration costs. So you'll see by the end of year 6, the liability stands at 186,162, which is some 18,000 ahead of the right of use asset. Now, why did I stop at year 6? Well, the reason for that is that at the end of year 6, I suddenly look at this agreement and I see myself in 4 years' time being reasonably certain that I'm going to renew it for a further 5 years. Now, it might be a bit early that year 6, I accept that, but I'm making my decision that's reasonably certain that I'm going to renew this in 4 years' time. Now, if that's the case, I now have to extend the lease term from 10 years to 15 years, or if you like, 9 more years to go. 4 under the original agreement and 5 under the secondary side of things. So that's where we're going. We've got 9 more years to go. I have to change the discount rate. I cannot use 5% anymore. I have to use the government rate, which is now in at that time, at the end of year 6, which we'll assume is 6%. Now, what we always do is we remeasure the liability first. So let's take 4 payments still of 50,000 at discount at 6%, and 5 extra payments at 55, also discounted at 6%. That gives me 378,174. Now I've got to bring my liability up from 186 to 378. That's 192,012. And if I increase my liability by that, I must also increase my asset by exactly the same amount. So as I say to you, the liability and the asset are not fixed. They will change over time. So if we now look at the table going forward from year 7 right through to the end of year 15, let's look at the right of use asset. We have 360,000 now out of the asset. We've 9 years to go. So we divide 360 by the remaining 9 years, and that's 40,000. As you'd expect, because the useful life has been extended, we now have a lower depreciation charge of 40,000 rather than 42,000. And then on the liability front, we've got quite a high interest there in the year 7 and year 8, as you'd expect, because partly because of the 6% rather than 5%, and partly because we've obviously brought in quite a large extra amount of liability onto the balance sheet. Now, that's how it works in terms of reassessments. But the other thing that I think is even more likely to happen in some of the agreements that you probably sign is that you find yourself now with surplus space. You find yourself where many of your staff are now working at home, or if they're not working at home, they're in hybrid working. So you don't need the same square footage that you've previously used. So you're trying to renegotiate the lease because maybe there's no termination clause or something in the agreement, but you're trying to talk to the lessor and renegotiate the lease. So the most likely scenario is to reduce or decrease the amount of square footage that you're renting out. And that will require you to carry out a double step procedure, which I'll show you in the next slide, where you have to remeasure the liability and decrease the asset. But there will be an element of it which will go off to your statement of comprehensive net expenditure as a gain or loss. We'll show that in a second or two. If, however, you want to increase for some reason the amount of square footage that you're renting out, then there are two possible ways this can be done. Well, they're not options. They're basically one or the other. If the agreement that you're about to sign is going to be paying a rental, which is commensurate with the standalone price you'd expect, so you're paying normal market rate, then don't worry about the existing agreement. This is almost like an extra agreement coming in. It's a separate lease contract. But on the other hand, if the lessor has been very generous to you and says to you, look, you've been a very good client of ours, and I'm going to offer you a discount from the normal price, then this is an adjustment to the existing agreement, and that requires you to remeasure the existing agreement, both the liability and obviously as a result of that, you adjust the right of use asset. Now, the example here, if we enter a lease for 5,000 square meters for 10 years and we're paying 50,000. After 5 years, we decide, oh no, we've too much square footage. We want to get rid of half of it. So we want to go back down to 2,500 square feet. So we renegotiate the lease with the lessor, and they've decided that we should pay 30,000. We're not going to get down to 25 because we're only using half the space. So they're going to charge us a higher rental per square footage, probably. So that's why it's 30,000. Now, at the beginning of year 6, the lessee's incremental borrowing rate, again, the government rate, we have to use because we can't get the rate implicit within the agreement. Now, let's just assume that the carrying amount, you can work it out yourselves, but let's assume that the carrying amount of the asset is 184 and the lease liability is 210. Generally speaking, you will find that the lease liability will be higher than the asset value. Now, you go through this in 2 steps. Step 1 is deal with the physical scenario first of all. We are reducing our square footage by 50%. So let's reduce the liability by half, let's reduce the asset by half. And that's meant that down goes the liability by 105,000, down goes the asset by 92. But they're not equal. And therefore there's a difference. And that difference of 13,308 is argued to be a gain on the renegotiation of a lease. And that will go in as a gain inside your statement of comprehensive net expenditure. Now, the only problem is that that figure now, you've brought the liability down to 105,309, but that doesn't reflect what you really owe. And if you look at the top of the slide there, you'll see that if you work out the 30,000 at 5% for the next 5 years and discount back at that 5%, it comes out at 129.84. So the liability is now too low. So we have to push it up by 24,500 odd. And if we push the liability up by that, we must also push the asset up by the same amount. So you'll always have to go through a double step approach where you're dealing with a renegotiation which results in a decrease in the amount of square footage that you're actually renting. Now, something which is a little bit different, which don't tend to find in the private sector, is something which is called peppercorn leases. Now, peppercorn leases are mentioned specifically in the government manual because they are defined as leases for which the consideration is zero or is very, very small, certainly significantly below market value. Now, they are still within the scope of IFRS 16 if they meet the definition of a lease in all aspects, apart from the figure that you're paying for the consideration. So they are included in the standard. Now, how are you going to deal with peppercorn leases according to the government manual? Well, you've got to recognize a right of use asset, and there's no point in you putting it in at zero because that doesn't reflect its true value. So what you have to do instead is to initially measure it at its current value in existing use or fair value, depending on whether the right of use asset is held for its service potential or not. So you need to go back into section 10, that's on the fixed asset element, or plant and machinery element of the FReM. That's section 10 of the government manual. If you're talking about the heritage assets, however, you're dealing with some separate paragraphs as well. But the important thing is it has to be at fair value or current value existing use. Then, of course, your liability is virtually nothing. It's zero because you're not paying very much. So you're going to have an asset which is way ahead of your liability. So the double entry doesn't work that way. So you're going to have a balancing credit. And therefore, you've got to put that balancing credit's got to go in somewhere in your financial statements. And it's argued to be a form of government grant. Under IAS 20, that's the government grant section. And so goes in straight away as income. So you report that as income if you're in fact setting up a peppercorn lease. Then you apply subsequently the right of use assets follow the same principles as IFRS 16 as adapted and interpreted. Now, there are, however, slightly different rules on transition going into the stand for the very first time. So any peppercorn leases that were not previously classified as finance leases are recognized as follows. The right of use asset again goes in exactly the same way, existing use or fair value. The lease liability again is measured at the present value of lease payments discounted using again the incremental borrowing rate, which is going to be the government rate. But there again, where does the difference go this time? It can't go into income because it's something that happened in previous years. So it has to go in basically as part of an adjustment, the opening balances of taxpayers' equity or other component of equity as appropriate. So that's how you deal with peppercorn leases. I'll briefly talk about subleasing. I don't think it's hopefully major within the public sector. It can be quite complicated. Essentially, of course, we're talking about a head lessor renting out a property to a lessee who then becomes an intermediate lessor because they sublease it to a sublessee. And that diagram more or less summarizes what's going on there. Now, the intermediate lessor has to account for the head lease and the sublease as two separate contracts. So when they're looking at their own lessor, they've got this problem of follow the rules in IFRS 16 for that as a lessee. But then they've got to follow lessor accounting rules when they're dealing with the sublease agreement. So they're into this problem of deciding whether it's a finance lease or an operating lease in that situation. So you have that extra problem there when you're acting as an intermediate. Now, at the commencement date, if the intermediate lessor can't work out the rate implicit in the sublease, then again, you have to use the discount rate used for the head lease, which again would be the government rate in your situation. However, if the head lease happens to be a short-term lease for which the company has elected the exemption, then as an intermediate lessor, you can classify the sublease as an operating lease, and therefore you'd be writing off the expense then. I would say you wouldn't writing off, you'd be capitalizing it. Here's an example, and it is kind of slightly complicated, but we'll try and go through it quickly. L enters into a 5-year lease for 5,000 square meters office space. That's the head lease with M, who's the head lessor. At the beginning of the 3rd year, then the intermediate lessor subleases the 5,000 square meters for the remaining 3 years to N, the sublessee. Now, L, the intermediate lessor, has to classify the sublease with reference to the right of use asset. So it's got lessee accounting basically for the head lease. And because the sublease is for the whole of the remaining term of the head lease, the sublease then is for a major part of the useful life of the right of use asset. So therefore, it's probably, well, it's unlikely to be an operating lease. It would have to be treated as a finance lease under lessor accounting for the second agreement. So at the commencement date of the sublease, the intermediate lessor has to de-recognize the right of use asset related to the head lease and instead recognize the net investment in the sublease. Any difference between the carrying amount of the right of use asset and the net investment in the sublease, that has to go into profit and loss. And you continue to recognize the lease liability, and you still owe that money to the head lease, as you understand, to the lessor. During the term of the sublease, you recognize both interest income on the sublease and the interest expense on the head lease. So just have to go through that slowly. They do provide you with examples in the document in their base of conclusions. In their examples that they have. They have a whole booklet on examples. Now, the one thing that to kind of almost wind up this section is to talk a little bit about disclosure. There's a huge amount of disclosure required under the standard. You got to disclose the depreciation charge you've put through, and that's got to be broken up by class of asset. You got to disclose the interest expense you put through in your lease liabilities. And because you are not capitalizing short-term leases, you need to disclose what expense you put through for them. What are your commitments for your short-term leases? If you've decided that you don't want to capitalize your low-value assets, then you've got to tell us the amount you've expensed. You've got to tell us the amount of any variable lease expenses that were not dependent on the index, any income from subleasing, and any gains and losses that have resulted from subleasing. As we saw, there would be differences emerging when that occurs. So that's quite a lot. And then when you go to the balance sheet, you've got to decide, should the right of use asset go on separately onto the statement of financial position or balance sheet, or merely add it in with all your other property and then disclose in the notes? Well, that's a choice you have, but if you go for the notes, you must disclose under which heading, is it plant and equipment or buildings? The right of use assets are included. The same applies, same logic for the lease liabilities. You can show them separately on the statement of financial position, or you can simply add them in to your notes. But if you again put them into the notes, you have to disclose under which heading they're included, particularly current, non-current liabilities. And if you have any right of use assets which are investment properties, they will have to be included within your total for investment properties. So that's the rules on presentation. Now, in addition to the profit and loss disclosure and the balance sheet disclosure, you have some extra bits as well. For example, it's important to disclose the general nature of your leasing activities. Is it just buildings, or are you involved in motor car leasing or plant? What type of leasing are you involved in? And for significant leases, you need to discuss or give information in a narrative sense anyway. What are the kind of extension or termination options that you've signed up to? if there are any variable lease agreements, what are they? Um, are there any residual guarantee payments within the agreements you've signed? Are there any lease commitments that you have not yet commenced? And that's all about trying to help the reader assess future cash outflows that are going to emerge from those various aspects. Again, unlikely in the public sector, but if there are any restrictions and covenants in your ability to borrow externally, then you have to disclose that. And you have to give also details of any sale and leaseback operations. Now, I've taken this directly from the guidance notes, which are in the provided by Treasury, specifically for the public sector. And this is what they've said. They call this examples of additional information. The following provides examples of additional information that may be needed to meet the disclosure objective in the public sector context. Well, I've already mentioned in the previous slide there the general nature of lease activities. So they're suggesting that you need to talk about the reasons for entering into leases, the flexibility provided by leases, any restrictions imposed by leases, or any deviations from normal public sector leasing practices. Then going back up there, you see extension or termination options there. So they're saying for the public sector, any information relating to extension or termination options, include the reasons for using those options, how prevalent they are, their magnitude of optional lease payments to the ones which are already in the liability. And then very specific to the public sector would be peppercorn leases, again, including reasons why you entered into them, how prevalent they are, the underlying assets, and trying to give a comparison between peppercorn and non-peppercorn leases. And then it goes on to say, finally, their provision of the above or other additional information about leases disaggregated by class of underlying asset or by operating segment categories. Now, there are transitional arrangements, maybe probably they're over now, you're probably through that at this stage. But anyway, there would have been situations where under the new definition of a lease, you may have discovered, oh dear me, I thought that was a service contract, but when you look at it again, it's a lease agreement. So can you reassess it at the time of introducing the standard for the first time? The answer is no, you can't do that. So if you didn't believe it was a lease originally, you don't suddenly change your mind. That's good news. And the cumulative effects of bringing in the standard for the first time, they go in as an adjustment to your taxpayers' equity, opening balance of taxpayers' equity. And any right of use assets for leases that were previously classified as operating leases, they're the ones that are capitalized now. They're recorded at the amount equal to the lease liability as adjusted by any prepayment or accrued lease payments relating to that lease recognized in the statement of financial position immediately prior to the initial application. So you don't have to go backwards. There's no retrospection in a sense. The other transition arrangements, low value leases, this is a situation is mandatory at transition. You don't go back and look at your previous low values, only future low values, you make that choice where you want to capitalize them. And leases for which the lease term ends within 12 months, you don't need to adjust those, but you can use hindsight in determining the lease term if the contract contains options to extend or term lease. So you may have taken out a lease 15 years ago with 5 years to go, and then you find, well, you're definitely going to renew it 3 years before you brought the standard into play. Then you can use that and say, well, that's now 8 years to go rather than 5 years to go. So you can use hindsight, and I think that's sensible. Now, just to summarize all we may be repeating myself here, but these are the other adaptations and interpretations. We've already covered the fact that the definition of contract does include intra-UK government agreements. So where Department A and Department B are involved, A renting out to B or B renting to C, whatever it happens to be, I think they are included. You must apply It's mandatory to not capitalize short-term leases. You have to use basically the PES paper discount rates where you cannot readily determine the interest rate plus the lease. So we've covered that already. So those are the other adaptations and interpretations which are in the document. I have actually forgot, I did actually put an example of sale and lease back into it. I'll not spend long time in this one, but it's all about the link between IFRS 16 and another standard, which is a fairly recent one on revenue, which is known as IFRS 15. Because the way we deal with sale and lease back used to be dependent on whether we had an operating or finance lease. That's all gone now. And really, the new rules are whether it qualifies as a sale under IFRS 15. Now, it can only be a sale from A to B if the buyer definitely obtains control. If the consideration is not equal to fair value, then the difference is a prepayment or additional financing. But the key thing is there must be a transfer of control from the seller to the buyer. That's the main thing. And the actual double entry booking, this is what this is covering. It's the complicated bit is from the seller lessee. It's not complicated from the buyer's point of view because they simply apply normal lessor accounting. But from the seller lessee's point of view, they've obviously got, if they retain part of the building, well, they are retaining it, of course, then they have a right of use asset, and that has to be a percentage of the previous net book value of the right of use retained, and that the amount's retained, and then the gain loss must only be recognized so the rights transferred to the buyer or seller, because it may be that you're only renting part of the building back again. You'll notice also if the fair value is not equal for sale, is not equal to the fair value of the asset, or the payments are not at market rate, then you have either a prepayment or you could have additional financing. And that's measured, as you see there down at the bottom, as the difference between the fair value consideration for sale and the fair value of the asset. And the difference between the the present value of the contractual payments and the present value of the payments for the lease at market rates. That's complicated, so you really need to do an example to illustrate that. Here is the seller lessee selling a building for 2 million, but it's selling it for more than the fair value of 1.8. And that's going to lead to a reduction in what I would call normal rental then thereafter, or maybe, higher rental probably thereafter. And then the book value is 1 million. Now the lease back is for 18 years, 120,000 per annum in arrears. The implicit rate is 4.5%, leading to the present value of 1,459,200. Now, if you look at the figures, the easy figure is the bank, because you debit the bank 2 million. The easy figure is building, because you're crediting the book value of 1 million. You're crediting the financial liability at 1,459,200. So those are easy. The two figures which are difficult is the right of use asset. Now, the right of use asset should be the same as the liability, which is 1,459,200. The problem is that they sold the building for more than the fair value, 200,000 more, and that has to be taken off, and then multiplied by 1 million divided by 1.8, being the book value over the fair value, and that works out at 699,555. Now there is a balancing figure there, as you'll see in how it's calculated, which goes into your profit loss of 240,355. Now that's the situation where there's argued to be a genuine sale passing the rules of IFRS 15. If, however, this is the lessor. The lessor simply puts the building onto their balance sheet and they record a financial asset based on the future payments discounted back to present value. Okay, and then subsequently any income or any receipt comes in is split between the return of the lease payments and the income. If there's no sale, then clearly that's easy. You put the money into the bank and you record the 2 million as a financial liability. So that's straightforward. Now, I'm not really covering lessor accounting because I think that most people are involved as lessees. But there are some changes. There are minor changes which are caused mainly by the changes which have been made to lessee accounting. And as I said, the main thing that they've done is to retain the distinction that exists between finance leases and operating leases. So as I say, it does lead, we can't end about it, it does lead to double counting. So the same asset will be in the books of the lessor and the lessee, albeit at different values. But there is no attempt to give any relief in that situation, where there's intergroup situations, for example. Right. One interesting change, which I know would affect, I think, one or two departments. For example, the court service would have the building downtown that was under a PFI agreement. Now, they don't call it PFI in international accounting. They call it PPP, public-private partnerships, but it's the same thing. And the rules in the government manual have always been, certainly for a number of years now, that where you get involved in a PFI, PPP type contract, then the user of the asset has to record the asset on the balance sheet as well as the liability. But it was put in at the initial amounts of the future payments, discount back to present value, and that was it. If they were attached to an index such as CPI or RPI, which a lot of them are, you never changed the asset or liability. You never did that under the rules for PPP. Now that goes against the rules in IFRS 16 because IFRS 16 requires you to change the liability and change the asset every time the index goes up. So in order to make sure that PP arrangements are brought into line with the new rules of IFRS 16, we've had to do exactly the same for PPP arrangements as well. So from 23-24, so just this last year that's finished, last March, reporting entities must record indexation-linked payments in PPP in accordance with IFRS 16. And again, there is guidance on how you do that in the HMT guidance, application guidance payment. So it's simply bringing into line in those three paragraphs in section 10 of the manual, bringing PPP arrangements absolutely into line with IFRS 16. Now, just a little bit about that. There was no need to go back to April 23 for changes in payments since the arrangement was set up. Sorry, there is a need, apologies. You had to do what's called a cumulative catch-up approach. So you had to increase the asset and also credit your opening retained earnings in that situation. You also had to, any subsequent measurement, whenever there's a change in the cash flows, you have to charge that to the finance cost and credit the liability. You don't change the asset. Private sector would change the asset, but the public sector, you debit finance costs. So the asset, in fact, remains the same subsequently. And that was all about making sure that there was consistency across government approach. Did I say it was a gain? It's not a gain on the initial measurement. It would be a loss that would be brought in. There is a worked example. I'm not sure it's really required for me to go through this in detail, but I put the example in anyway for you. It was given by Treasury to help people understand it. They actually included a service element which had to be written off to the statement of comprehensive and expenditure. You'll see there it's £500 per annum. But it was a situation where there was a PPP agreement involved in this, and it's all about trying to work out the transitional arrangements. Now, without going into the detail of it, what this little example does, it shows you what the figures would have been under the old standard IFRS 17. And if you go through the interest going in and the cash payments going out, you would end up with 56,873 down at the bottom there as the liability. But if you had had you applied IFRS 16, you would have seen that there would have been a remeasurement going in there, PPP liability remeasurement, which obviously affects the figure that goes in to the liability. And so by the end of the start of the 23-24 period, the liability should have been 59,720 under the new rule. So this is the catch-up approach. And so when you compare that, if I go back for a second, with 56,873, there would be a cumulative catch-up of 2,847 there in yellow, which had to be brought in as an adjustment to your opening reserves, opening taxpayers' equity. Now, as I say, I'll let you go through that yourselves if that it's probably not important now because you've probably gone through that already. But they did show that to show you how to go about switching in to the new agreement under the new rules. And that's the period post-wise. So you can see the remeasurement going in every year, and that does increase the interest charge going through, as you can see there. Right, so that's basically the leasing. Now, I did promise that I would cover a couple of other topics in the session. So for the last...
Robert,
yes, absolutely.
Just a few questions.
Yeah.
I mean,
Right,
you've sparked a lot of interest in this. So there's a few questions in the chat.
Far ahead.
One of them from Peter. Peter's asking about non-recoverable VAT and should it be included or excluded in terms of the valuation of the assets.
Well, that's not covered in IFRS 16. That would be covered by the rules on VAT, which I suppose are not in international accounting, but generally speaking, they were in local accounting years ago, and you always had to capitalize that as part of the asset. So I would have thought, it's not written down in stone anywhere, but I would have thought that the rule would be, yes, you would have to capitalize it. Yeah.
Okay, thanks. Another little question in about, is there any leases that you wouldn't capitalize because they were too short?
Oh yes, I mean that's the figure of 12 months. You're not allowed to, under the public sector adaptation, you're not allowed to capitalize any lease which is shorter than 12 months. So that's definitely the case.
Okay. Another one about salary sacrifice schemes that are in the public sector for leased cars that employees can avail of. I mean, is there anything that's relevant in relation to the treatment of subleases?
Well, that's an interesting one. Subleasing effectively to the staff member, effectively.
Yeah.
No, I mean, basically, you're not worried about from the staff member's point of view. It's really from the point of view of the department, and obviously they would have to follow the subleasing rules that I was talking about there.
My own sort of view on that was, if I've read the question correctly, is it's an agreement between the individual and the leasing company. It's
no
impact on the books of the department.
Oh no, I can't see that. No.
Yeah. Final question that I have here, because I know you're keen to get on. Would a private limited company who are primarily funded by the public sector, such as the health board, would you recommend that it followed public sector rules or the private sector rules?
Oh, I don't know under what framework they're actually reporting now. To be honest, it probably doesn't matter very much because the rules for private company are FRS 102, which has now introduced exactly the same rules as IFRS 16. But I couldn't comment exactly. I would assume they probably are preparing their accounts under FRS 102. In which case they would follow those rules, but they are the same. They are the same.
Okay, thank you. I know there are a couple of other questions in the chat, but I know we've only 15 minutes left, and we're very keen for you just to give us a little bit of an overview of other developments, Robert, that are happening
Right.
in terms of changing accounting standards.
Right. Well, I'll quickly run through this. This is one which is a change in the way that you value your non-investment assets. Now, I was trying to find out whether it's been totally finalized, and I kept looking at the uh, Treasury website, and I still seemed stuck on this exposure draft. But I thought it had been agreed, but I haven't got the evidence to prove that it has been agreed. That's my problem there in this particular area. But anyway, the proposed changes that they're making to how you value your non-investment assets. They're saying that assets which are held for their operational capacity will now replace what used to be called networked assets, specialized assets, non-specialized assets as asset classes, because they're trying to reduce the number of asset classes that you would have and make it simpler by introducing a single measurement base for this new asset class. So that's also helping to remove any uncertainty as to which particular class of asset you belong to. And the other thing, big change is Treasury have taken the view that the government manual should remove the requirement to consider alternative locations when you're using depreciate replacement cost, if that's when you're using that for valuing your asset. In other words, assets must now be based the valuation on their existing site, existing location. And the reason for that is to say, well, look, your decision to relocate somewhere else, that's a future policy decision that hasn't been made yet. So it doesn't make sense to do it on alternative sites. And also, asset valuations based on their actual location are far more understandable to users. And that's the rationale for that. So those are the big changes that are happening there. They're also not doing reducing the processes there from 5 to 3. Um, 5 original ones. You'll see the quinquennial valuation um, is still there, supplemented by annual indexation. But B has gone. The quinquennial valuation supplemented by an interim valuation in year 3 is gone. Annual valuation's gone. Rolling program, yes. A rolling program of revalues over a 5-year cycle with annual indexation applied during the intervening 4 years. And you're still going to use non-property assets for appropriate indices. So it's all about simplifying the way that we go about valuing our non-investment assets. As regards intangible assets, they believe that Treasury believes that a differential approach is probably the most favorable because it allows, as you can see there, the application of a relevant and practically achievable accounting policy and enables the public sector to apply optimum cost benefit measurement as such. So they've determined the best way to do that is historic cost. Glad to see that. Intangible assets is very difficult to value. Intangible assets in any way, I think it's very, very difficult to come up with a definitive figure. Okay, so that's really I'll not go through that one. There's some transition arrangements where if you've already been revaluing, you're going to have to go back, if you like, to historical costs. So there will be an adjustment there. Oh, sorry, not adjustment. You'll just use what the figure that you already had if you have been revaluing, and that becomes your deemed cost going forward. So there'll be no retrospection there. And that's just the various dates of this new agreement. You'll see it's all supposed to come in. As I say, the proposed text, it's an exposure draft, yes, but I haven't seen the final document, and it's supposed to be coming in this April. So we need to see the final document fairly quickly. I have seen this document. It's from the valuation office, something that you might want to drop. It just refers the fact that the government, Treasury, through FRAB, the Financial Reporting Advisory Board, are bringing in these changes. So they're very much aware of that. But it's only about a 10-page document. You might want to download that. But again, notice that's in draft as well. Okay, so it's just to make you aware that there are going to be changes there, as you can see, for the better, I think, in terms of the valuation of non-investment assets. Now, in terms of what's going on internationally, the biggest change that's happened in the last 12 months internationally is the publication of IFRS 18, the presentation and disclosure in financial statements, which actually will replace the very first international standard known as IAS number 1. It comes into effect in the private sector from January 27. So it's still a couple of years further off. I would imagine they'll bring it in 27, 28 into the public sector. So you're still quite a few years away before. Certainly the private sector is going to encourage people to go in early if they wish. Now, the changes are making quite a lot of it is not changing. IS1, particularly the things about the accruals concept and the basic principles of accounting or all that kind of stuff is all there. Where they're really homing in on is changing the layout and presentation of the profit and loss account or income statement and the notes which go into the financial statements, with some minor changes going on to the cash flow statement. But they're not touching the balance sheet or statement of financial position, nor the statement of comprehensive income or the statement of change in equity. They remain the same. They've also helped by bringing in new principles on when you should aggregate things together and when you disaggregate. And the key principle there is aggregate items which are similar, have similar characteristics, and disaggregate items that have different characteristics. Pretty obvious. But don't obscure material information and reduce the understandability ones. That's what they're trying to make that across. I'm not sure the principles are that useful, but that's what they've tried to do to help people decide when to aggregate and when not to aggregate. They've introduced 3 defined categories into the new profit and loss account and 2 compulsory subtotals. Now, they are on the right-hand side of the next slide and the left-hand slide. Now, you'll see on the right-hand side in red there, operating, investing, and financing. And that should be familiar because that's the same headings we have in the cash flow statement. So they're really trying to bring the statement of profit and loss into line with the cash flow statement. And the 2 subtotals which will be compulsory are operating profit and profit before financing and income tax. But companies will be allowed to bring in alternative ones as well. And up until now, they've had to analyze their expenses by either function or by nature. But you'll see in the analysis of expenses there, it's a mixture of the 2. And that will be allowed in the future. You'll be able to put in whatever headings you want into your operating profit to make sure it is in line with what's needed to give a true and fair view of your performance. So there we have 2 mandatory subtotals and 3 divisions inside the profit and loss account. Then, if you happen to analyze your expenses by nature, any of your items by nature, you will have to disclose 5 items in the notes to the accounts and where they are included within your profit and loss account. They are depreciation, amortization, employee benefits, impairments, and inventory write-offs. And the example they give is by note. So there you'll see depreciation. It goes into 3 different places in the profit and loss. Employee benefits going into 4 different places. You'll see R&D going into 2 different places and so on. So you'll see the breakdown of the 5 there and where they've gone into the profit and loss accounts. So that will be a compulsory note. They've also introduced something which is not relevant from the public sector's point of view, but they're introducing a definition of MPMs, which are management defined performance measures. These are arguably very, very important from analysts' point of view. When they're looking at a company, they don't tend to go into all the detail. They tend to go and look at key ratios. And these key ratios are up until now been picked out by management to flatter, in many cases, their performance. Now what they're trying to do, they're saying, we're going to define these and we're going to say that you must disclose these in a certain way. So the definition is down at the bottom there. There are subtotals of vacant expenses on those listed by IFRS 18 in public communications outside the financial statements in a way to communicate information by the management team. They then try to explain what is an NPM and what is not an NPM. I'll not go into that now, but essentially they've got a list there of what goes in. So that's the other big area. And again, I'll let you go through that yourselves as what needs to be disclosed. But the whole thing has to be tied in to the official figures under IFRS standards. And you have to describe how you believe the measure you choose communicates management's view, how it's calculated, have you changed any of them in the course of the last 12 months? That's the kind of things that they're looking for. They do believe they're very important, but it needs to be tidied up, and that's what they're doing. Now, the cash flow statement, the main change there will be that interest received, instead of going all over the place, must now go into investing. Interest paid must go into financing. Dividends paid must go into investing, and dividends paid must go into financing. The only difference there would be for banks and financial institutions whose business is obviously earning interest income from lending money out. So it doesn't make sense to put that in to investing. That's really their operating. That's really their operating income. So businesses with specified main business activities, they will have a slightly different approach. But the vast majority of entities, they will have to be more precise where they put these various items in the cash flow statement. And the last thing is this new compulsory total for operating profit or loss, which is now required by the standard, will be the only starting point for the indirect method when you're working out the cash flows from operating activities. And that's it. That's more or less it in terms of what I was trying to cover in the time. And I see there's quite a few there questions. Let's see. Have I time to look at a couple of them?
A couple of minutes, Robert, if you could.
Gosh, there's a long one there. Within the flow chart to determine whether leases exist, it refers to if the use of the asset is predetermined, yes, and the customer operates the asset and it does contain a lease. How is operate defined in this? Oh.
Good question.
I am not sure I can answer that. I need to go through that in more detail. They rent rooms in a building and aren't key holders, arrange security or dictate opening time, so must comply with the lessor's offering. Oh, well, that doesn't matter. If the lessor tells them when they open security, that's still, within those remits, you still have control over the asset in that case. So that's a lease, I think. I think that would be a lease.
We're kind of running out of time a little bit, Robert. We're kind of coming.
Right. Okay. Sorry about that.
I know your enthusiasm is fantastic. I really enjoyed that presentation. You have your enthusiasm and passion hasn't waned at all. And I know folks will have really enjoyed that. So thank you so much for taking the time to go through all of that. We will share the slides. We've recorded the session as well. So I think there's a really rich presentation that hopefully members will get a lot out of. We hope to get you back again, Robert, later in the year. And that's something that we want to try and get into. But I would just like to thank everybody as well for coming along today and engaging in the presentation. We'll get our summary of events out for the rest of the year in the next couple of weeks, and hopefully there'll be something for everybody in that. So thank you for coming along, and thank you again, Robert, for your time today. It's been really, really useful. Thank you.
Thanks, Graham. Cheers.